Online car retailer Carvana has been a pandemic darling, up more than 130% over the last year. Valued at $45 billion, its market cap now rivals some traditional automakers like Ford, Honda, and Stellantis. But you can see that the market cap number is down in some of the pre-market trading after the company's fourth quarter report last night. Stock's down by about 1.4%. It reported a bigger than expected loss, but revenue beat expectations, and retail units that were sold were up 43% over a year earlier. Joining us right now to talk more about it is Ernie Garcia. He's the founder and CEO of Carvana. And Ernie, thanks for being with us today. This is a really interesting story, made much more interesting by what's happened over the course of the last year. We'll get to the earnings in just a minute, but I want to start with your shareholder letter because you made a really interesting point in it. You talked about the improvements that the company has seen in spite of all the difficulties of COVID. And I'd argue that it's almost because of COVID. I think people looked at Carvana in a whole new way when they realized they didn't want to be maybe in contact with the dealership as much. It might be easier to actually buy a car online. I know it was tougher to operate during these times, but how much do you think you benefited just from COVID changing people's minds?
Sure. So I think there's a lot there. I think the business that we've tried to build is a business that has a completely new supply chain to sell cars online, a way lower cost structure. And I think what we're able to give customers is a better selection, a better price, and a better experience. And so I think those things have always been attractive. I think what COVID did is it shifted psychology faster in the direction of trying new things. And so I do think that the business probably has more demand today than it would have had absent COVID. But I think the business itself was on the same trajectory regardless, and just kind of the psychological level shifted faster.
So what did you have to do differently in terms of operations, and how did you streamline or maybe pivot to deal with the changes that COVID brought?
Sure. Well, so I think basically our adjustments to COVID were much more dramatic probably than many companies had to make, just because we came in on such growth footing. So we came into the year expecting our biggest growth year ever. For 3 years in a row, we've been the fastest growing automotive retailer. One of those years we're the fastest growing automotive retailer ever. So we were growing really, really quickly. The pandemic hit, and obviously kind of everyone immediately pulled into a defensive position. No one really knew how that was going to play out. And that was a really tough transition for a growth company that was planning on a huge growth year. And then probably a month and a half, give or take, later, once we got into about May, stimulus checks came out, demand started coming back, the psychological shift happened where customers wanted to buy more things online. And I think that shifted a ton more demand toward us. So then we had to rapidly pivot in the other direction and prepare for rapid growth, which we've done a pretty good job of.
Ernie, let's talk through some of the numbers because revenue was better than expected. Your units sold, I guess cars that you sold were up 43%. If you looked at the revenue number, it was up even more than that, an increase of 65% to $1.826 billion. Gross profit before some of the other items was $243 million. That was an increase of 71%. So if you look at those numbers, you were making more profit off more revenue, off more cars sold, and that's the good way to do things. But it is pretty thin profit margins. How do you tackle that, and what do you do this coming year?
Sure. So, I mean, I think, as you said, that was a ton of progress. And I do think that in automotive retail, you're selling a pretty expensive item. And so the margin relative to the revenue is less than some other verticals, but not much less than most of the other retail verticals. It's pretty much in line with what you see in many other retail verticals. So I think we're extremely excited by that. And then you can kind of see as you move down the income statement to gross profit, you see even more growth. And that's because we're growing in units, but we're also growing in the way that we're monetizing the transaction. So we're really excited about that. And then that growth continued heading into January. I think a pretty amazing result. We grew by 80% in January with half the inventory that we had a year ago. So there's clearly just a ton of demand for our product right now.
Do you think that demand continues after things open up again and people can kind of get back out there? Do you think you'll have kept new customers and that you'll continue to pick up customers at a rapid pace?
So I think every business needs to build a business that is better for customers. And then I think getting customers to change their behavior is very hard. And I think the pandemic was helpful in that adjustment of being open-minded to trying something new. I think generally when customers try something new that is fundamentally better for them because they have a better selection, they have a better price, they get a simpler experience, they tend to stick with it. So I think our job now is to keep growing the business, keep delivering great experiences, and I think the growth will hold.
Ernie, thanks so much for your time today, and hope to see you again soon.
Shepard Smith here. Thanks for watching CNBC on YouTube.